All right, we have more changes unfolding in the U.S. economy and in the U.S. housing market. Changes that have brand new data just released by the National Association of Realtors showing just how much of a bear market housing is really in right now. So bad, in fact, for a whole host of reasons that continue getting worse. Well, it's not just the NAR's new numbers that spell this out, but this brand new note just released by JP Morgan's Marko Kolanovic, a note that you have to see, laying out the cliff that most asset classes and our economy are headed for, asset classes that he says include residential real estate, even making comparisons back to '07, the run-up to the meltdown. And we'll look at some of the markets, the metros that are most susceptible with our interactive maps. There's an easy way to see this, to clearly see which markets are most vulnerable as this progresses, because time's running out, folks. But before we get started, press the like button and subscribe. It's all I ask for in return for making these videos. It helps me out, and I appreciate your support. So a lot just happened, right? And something to keep in mind before we look at what we're about to look at together is a vital metric or variable whenever you're trying to assess the broader economic picture, calculate what's coming down the road, a variable that has been getting smaller and smaller each and every day, and that all of these market pumps seem to be missing from their vocabulary. And what is it? Lag time, how long it takes before the effects of the Fed's tightening campaign reaches critical mass, enough to push us off the proverbial cliff. Well, that time, the lag time, is getting closer to running out. So far, it's been around 1.5 years since the Fed began hiking rates and tightening down the hatches. Well, for around 2 years prior to the meltdown of '08, people were doing the same thing that they're doing right now. Eerily similar behavior, actually. Debating a soft landing, seeing home prices inflate to these new highs, talk about how there's no catalyst for a major problem. Very few people saw it coming back then. If you called it a bubble, you'd be laughed off the stage. Well, just like then, the conditions are the same. The same events are playing out. And the vulnerability this time won't be subprime residential real estate, obviously, like it was then. But realize what caused the collapse back then. Everyone talks about subprime mortgages, but what brought that vulnerability to the surface? The Federal Reserve doing the same thing that they're doing right now, tightening monetary policy, raising the overnight rate, which, by the way, the Fed did much slower and to a lesser extent than they're doing right now today. You can see the difference in this table, raising rates 2,100% higher from COVID rate lows versus 753% higher back then. And why is that? Because the Fed knows more is needed this time around. The level of extra cash in the system, all the extra savings from government stimulus that were pumped out during the pandemic, like student loans and mortgage forbearance, and just like so much more, means that these higher rates, tighter lending conditions are finally beginning to have their desired effect with the most interest rate sensitive sectors of the economy, at least real estate in particular. Check this out. The NAR just released pending home sale numbers for August, for last month. We've now reached the lowest level on record, the worst pending home sales ever, and significantly worse than where they were even during the meltdown of '08. And realize what this means. The housing market is in like the perfect position to crash right now. I know some people like completely lose their minds when you say that, but it's true, folks. It's never been better if you were hoping to see this market get reset, because think about it, the only reason we haven't seen home prices come crashing down is because of how low inventory is. That's the only reason, with as little supply that this market has. And realize how low inventory really is right now. We're talking around like half the number of homes for sale when compared to pre-pandemic levels, which in a normal market would do what? It would send prices through the roof, but they are flat. They've been flat this entire year, more or less, even with record low inventory, for one reason. Nobody can afford to buy a house right now. They're just too friggin' expensive. Once inventory normalizes, though, which it will, prices will as well. And if you want some evidence of this, it's actually very simple to see. I can show it to you right now. If we pull up SnapForce Real Estate Insights, we can see what your local market would look like if supply were to normalize. This map shows every county in the country where supply, the number of active listings, is equal or greater to where it was pre-pandemic. So the only counties in color that you see are the ones that have equal or more inventory now than they did back in August 2019. Well, guess what, folks? What happens if we were to look at the home value map? They match up almost perfectly. So the markets with a normal level of supply, like in Austin, Texas, have home prices down 13% year over year. Southern Nevada has normal inventory levels. Well, what do you know? Down 8%. But what's more remarkable is the fact that even with how little supply there is, we're still seeing home prices falling in a lot of these markets. Look at all the red, folks. Bright red means prices are down double digits. So let me ask you a question. What's going to happen as inventory starts returning to the market? These markets in red and orange will fall even further. Now, there's two ways for this to play out, right? The slow way, where rates stay higher for longer, banks continue restricting new loan origination like they're doing right now, we'll see a slow grind down in prices. The faster way, though, the way that I personally think that the Fed is hoping for, is a period of forced selling to arrive. They've talked about wanting higher unemployment. It's just a matter of time now. How much more lag time in the pipeline before the effects of these higher rates and tighter lending conditions reach and touch enough of us to trigger something to break? Well, according to JP Morgan, the latter scenario is the likely one that we're looking at, and it's coming sooner than later, they say. They wrote this yesterday, September 27th, an absolute must read, in my opinion. Here's what they said. The note's titled, "With our price target now reached, what's next? Interest rates? History doesn't repeat, but it rhymes with 2008. They write this. In this note, we look at the historical and current headwinds caused by interest rates, which paint a very negative picture, fairly negative picture. The core risk for markets and the economy is tied to the interest rate shock of the past 18 months. Consumer loan rates have increased around 4 points, roughly 60 to 70% increase for these consumer payments, compared to only 1 point or 15% during the run-up to the great financial crisis. So the current change in interest rates is about 5 times larger than it was to the run-up of '08. They say investors should carefully monitor the propagation of the interest rate shock across markets and different segments of the economy. Now, they go into why there's yet to really be a strong impact on the economy and why credit spreads have yet to be affected. They say this: why is there little impact on the economy and markets yet? We think because lags are longer this time, which has resulted in complacency and broad acceptance of the soft landing or even the no landing thesis. As we will show below, this is also what happened going into the '08 crisis. Lags are longer this time for several reasons that are fairly evident. Now, they go into what those reasons are. I'm not going to read all of them. They go on to say this, though. If consumer cash balances going into tightening were higher than before, this will make the lag longer. If corporations locked in longer date financing at low interest rates, that will also make the lags longer, which we've spoke about many times. But until there is a need to refi and the wall of maturities gets hit, they go on, if mortgages were refied broadly at low rates, it will also make the lag longer. If there was pent-up demand for services post-COVID reopening, and especially strong reopening demand from China, that would also make the lags longer and put additional pressure on having a negative impact from these higher rates. Now, what we hear constantly, right, is that this is not 2008. There are no bad mortgages this time, which I really don't understand why people say that so often. The bad mortgages from '08 have nothing to do with it. They were a point of failure for the bubble to pop, not the only one. If it wasn't that, it would have been something else eventually. When the Fed tightens policy like this, tightens lending conditions especially, something always breaks. As Marco writes, saying this, that signs of stress are beginning to appear. One should also keep in mind that going into a crisis, there is no clear idea of how it may evolve or about the specific narrative or catalyst. Also, one should notice that for about 2 years going into the great financial crisis, there was a debate going on about whether the Fed could engineer a soft landing. So the timing of any decisive macro outcome is fairly uncertain, very coincidental, no? We're about 1.5 years into aggressive monetary tightening right now. Right now, everybody knows that the 2008 great financial crisis was about subprime real estate and exposure to banks like Lehman and Bear Stearns. What we find remarkable, though, they say, is that going into the crisis of '07, investors were discussing the exact same topics as they are today: Fed pause, consumer resiliency, strong landing, strong jobs, etc. All very coincidental, right? Deja vu almost going on. Anyways, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.